We also know the political appetite. No incumbent president has ever been elected in a recession environment.
Oh, yeah. Yeah, I think
And
the
if the
election
Democrats
years.
want to hold on to power
Yeah.
and the Treasury needs an easy monetary policy, what do you think?
No, I think the fact that it's an election year is definitely a factor that needs to be considered, especially when you look at the precarious nature of the fiscal position. But if we can just go back to your first question, are you surprised that, things have held up given the fastest rate hike in history? And I was, but then you kind of think about it more and you start to think about how there was so much, low rates for so long and these corporations basically binged on it. And same with these, when rates went down to zero after the pandemic, you had so many households refinancing their mortgages, and like 90% of them are fixed in the United States. And so when the Federal Reserve raises interest rates, I mean, it's just not going to affect them. And then you wonder why housing prices aren't going down. Well, people aren't moving because they don't want to move and then take on, a huge mortgage when they're locked in at like 3% right now. And so you have like a supply demand issue with the housing market. That's why you haven't really seen housing fall, I think, over the last couple, months, as many expected. And you have like corporations binged on this cheap debt as well. If you look at the S&P 500 debt, 50% of the debt doesn't mature till 2030. And you really don't hit that maturity wall until like 2025, 2026. So they have more runway. They basically binged on the cheap debt. And so they're not really impacted by this rise in interest rates yet. And this is why they say if it's higher for longer, eventually this is going to hit a wall. And people are expecting rate cuts. I think the market expects like 2 rate cuts next year. It's like 100% they expect it. And a lot of it expects almost 4 in the spring. But I think
Totally in what? Like 1.5, something like that? 150 basis points?
yeah, exactly. Yep, exactly. But like you have to think about what has to happen for them to do that. People always have to look through this, but things have to get worse if the Fed's going to start cutting rates. And so I think you could see a situation where the unemployment rate really starts to rise, like maybe up to like 4%. You could start to see corporate bankruptcies increase substantially, and asset prices start to fall. And Jerome Powell, he talks like this big game, but let's see if he talks a big game in that scenario, because I think what they're going to do is they are going to cut rates because of these treasury dynamics that you talked about, it being an election year. And maybe that's actually what Deutsche Bank is saying, because if they cut rates and they go back to their accommodative policies, I think you're going to see the S&P 500 rip. And I think part of the reason why you saw the S&P 500 rip this year is because bonds have been absolutely slaughtered. And so you're seeing like, where does that money go from fixed income after it's almost on the 3rd consecutive year negative returns for the first time in history? Well, it's going to go to like money market funds. It's going to go, and it's probably going to go to stocks. And so I think you saw some flows from fixed income into the stock market. And I think that's part of the reason why it surprised people with its performance this year, but maybe people didn't consider some of these dynamics.
I want to dig into one thing that you said there, which I liked, and I want to see if we can break apart this nuance and maybe challenge it a little bit. So you said typically the Fed would lower rates if things got bad.
Right.
And so a lot of people say, oh, it's when the Fed pivots, then the market crashes. But I think that's sort of like a lagging effect. The Fed typically pivots because things are already so bad. Yeah. It's not that the pivot causes the crash, it's that things are already going into a crash, so they pivot too late, right? And so you said typically when things get really bad, the Fed would pivot, employment has to go up, things like that. And I think what you said, or at least what I'll challenge, is maybe they don't have to be that bad for the Fed to pivot. Maybe it's the Treasury needing the money and the political environment that forces the pivot, not the market. Is that what you were saying?
Well, yeah. I mean, it's certainly, and you look at the interest expense on the debt right now as the Fed keeps interest rates. The government is one entity that didn't take advantage of the low rates, like households and corporations. And so they have a decent...
Explain that for a second, just so people can understand how idiotic that is.
Yeah. I mean, essentially they borrowed at higher rates, and I forgot the numbers exactly, Mark. I think like something like 50% of the debt they have to roll over in the next 12 months or something like that. And so they have to refinance at much higher interest rates. And it's very, very expensive when the debt gets to these high levels for the government to have to do this. And so the government wants.
But to your point, just real quick, the locking in, just so people can understand this, you mentioned earlier when rates went low after 2020, people refinanced their mortgages down,
Right.
and they locked it in for 30 years. The government had a chance to lock in debt at 30 years at these lower rates, and they didn't.
No, they issued on the short end instead of the long end.
Right.
So,
Right.
So that's why they have to refinance now, because they issued debt on the short end when they should have issued debt on the long end.
Like all the corporations and the
Yeah,
households did.
exactly.
The corporations and households were smart enough, and the government somehow didn't understand that.
Yeah, and this is actually why Stanley Druckenmiller was saying Janet Yellen should be fired, because that was one of the biggest blunders in Treasury history, is what he said. Because now we're going to have to face those refinance costs. And so that's why people say, like, the Treasury, and I agree with this, where the Fed can pretend like they're independent and that they have two mandates, which is, full employment and price stability. But in my opinion, when the Treasury gets in this position where if rates stay high, it really threatens like their solvency essentially. And they're going to tap Jerome Powell on the shoulder and be like, look, it's cute and all with your price stability mandates and all, but like, we seriously need you to cut rates right now. Like, this is becoming a national security issue. Like, we need you to cut rates. And obviously these conversations would happen behind closed doors and things, but I just think that there's more important things, and the Fed is eventually going to have to, take away its independence a little bit and listen to the Treasury. And that's happened throughout history multiple times, specifically during heightened geopolitical times, like during World War II, and there was during Vietnam, where the Fed and the Treasury really started to butt heads about Fed independence, about the interest rates, because once the debt gets to these levels and once the deficits continue to rise, suddenly the Treasury is like starting to tell the Fed what to do. And so I think that's what we're going to go into in 2024.
Yeah. I mean, if the Fed wants to keep the dollar strong, they don't want to lose control over the dollar. But if the U.S. government loses its status in the world, potentially a national security risk, then the Fed doesn't have anything to hang on to, right? If the government can't stay in power, then the dollar really doesn't have anything either. So it's like the Fed, sure, they want to keep the dollar strong, but if they don't support the government, they sort of lose it anyway. To your
That's
point,
a good point.
Right? So, and to your point as well, history shows many times that they have kind of lost that independence, and they've worked in lockstep. And so when you kind of look at that, and you look at the Treasury dysfunction that we had, in the last couple auctions, there's just no way that I don't see anyway. And I hate to say no way, because just like no way the stocks have to be repriced, they weren't. But it just seems like, how can the Fed continue to tighten? How could the Fed continue to roll treasuries or sell treasuries into the market when the Fed do that, when the Treasury can't even get all their treasuries to be purchased? Like the Fed can't continue to put more volume into the market at the same time.
Yeah, they used to be the one gobbling up all the treasuries, right? They'd be price insensitive. They would just buy anything with their QE programs, and now they're doing the opposite, just letting their bonds mature off. And so you don't have that buyer in the market anymore. And so I think that's why you see the auctions really becoming more and more atrocious, because there's no buyer like that in the market anymore. And so you remove the Fed, suddenly you're depending on, foreigners, suddenly depending on commercial banks and just, the private sector to kind of eat up all this volume. But the deficits are ginormous. Like, they're issuing huge amounts of money right now. The new bond issuances are so large. And that's why I think you're seeing the 10 years start to rise and rise and rise, because those bonds will get bought. It's just a matter of what yield they get bought at. And the higher they go, the more expensive the interest payment on that debt becomes for the Treasury.